How's it going, friends and family? My name is Amos. In today's video, we're going to be going over companies that just increased their dividend payouts. And to take a step back, here's my attempt at answering why the dividend growth rate even matters. Because when it comes to investing, for me, I think what's really important is that the business that I own and invested into, they do all of the heavy lifting and hard work. And that's why we should be really picky and strict about what we add into our portfolio. I mean, I'm guilty as well, right? I think every single one of us, we have a portfolio that's full of beautiful dividend compounders with cheese, but there's always that one ugly stock that we refuse to let go or sell at a loss. So I know, I'm a hypocrite. And so when it comes to investing in the stock market, don't just think of all of this as just buying into a stock. Instead, think about it from the lens of what Warren Buffett preaches. That when we buy into a stock, it's us buying ownership of a company. It's your company. So would you be happy with the business operation? Don't just look at the price chart or the stock history. Look at the financials, look at the fundamentals, look at the data. Does it make sense? And that's why for me, the name of the game is to acquire and then buy and hold high quality compounders. And a very good indicator of whether or not something is high quality is their dividend growth rate. Now, throughout the video, I'll be expanding upon that, but I don't want to make it too long of an intro. So what you see on your screen right now, we're going to be going over 17 different dividend-paying stocks. The first one is going to be Becton, Dickinson and Company. They're in the business of selling supplies, equipment, and tools for the hospital and medical setting. So when you think about the syringes, needles, the blood pouches, and everything in between. Now, their dividend growth rate, nothing too exciting. I hear you. A 0.9% increase. I think it's going from like $1.04 every quarter to now $1.05. So it literally went up by a penny. But what is my official rating? This might come as a surprise, but for ticker symbol BDX, I would buy. And it's because I just bought into them like 4 weeks ago when I was at the hospital, because I was taking a look at the room that I was in while my wife was recovering from the C-section. I kept noticing that almost everything was made by Becton and Dickinson. Right, and this is a company that I interviewed with to join their strategy team like 5-6 years ago. So I'm familiar with the company, but to see the real world equipment in front of my eyes, I was like, I gotta look into this company. And lo and behold, like 4 weeks ago, the company seemed to be undervalued. So I bought into them and then I sold after immediate like a 10-11% pop. It was a quick, pretty penny. So I would buy again given the right circumstances. So that's the first one. And then the next one is C.H. Robinson Worldwide, ticker symbol CHRW. Their dividend growth rate, their payout increased by 1.6%. And it's a trucking logistics company. Now, between you and me, as an American, I'll be the first to admit that America would absolutely collapse without the truckers. Because when I think about the supply chain, they're the reason why America's economy is still thriving. Without them, we would be screwed. But in the logistics space, I would rather be more bullish towards the railroads or even Amazon. So that's what I would rather invest into. So when it comes to C.H. Robinson, I'm not exactly excited about them. And the next company is Amcor, and they're in the business of selling packaging. So when you order something online from like Lululemon, you know how it comes in that packaging? This company does it. Or when you buy a CPG product, a consumer packaged good on the grocery shelf, or at Walmart or Target or at Ross, the packaging of that item, most likely made by Amcor. I think it's a very specific industry that they operate in, and their dividend growth rate is at 1.9%. Nothing to write home about, but what really set me off, and we're going to be looking at the numbers a little closer here in a bit, but their dividend payout ratio is really unsustainable. It's almost 200%. And for that reason alone, that's a no way Jose for me. I'm not interested in Amcor at all, because what good is it to have a 4, 5, 6% dividend yield if I know it's going to get cut in the next like 3, 6, 9 months, right? So not a fan of them. And then the next one is Tyson Foods. I think they're the second biggest producer of chicken meat. I I think the biggest one is based in Brazil. I forgot the name of the company, but this is player number 2, and they're always going through a scandal. So their stock price is really volatile because of that. But similar to Amcor, Tyson's, they also have a very unsustainable payout ratio. I think at the time of making this video, it's around 150%, meaning when you take into consideration the bottom line, the earnings, the profits, 150% of it are utilized to afford the dividend. So when you think about it, it doesn't take a rocket scientist with like a 20-inch dong to figure out like, that's not sustainable. That means they're tapping into their reserves, they're taking on loans, they're eating into their free cash flow in order to continue financing the dividend. For that reason alone, I'm not interested. And then later when we take a look at the numbers, I'll revisit some of the ones that I'm saying no way Jose to point out and articulate like, this is exactly why I'm not really interested. The next one is British Petroleum, otherwise known as BP, a huge oil and gas conglomerate. To be honest with you, not really interested. I mean, the dividend growth rate is kind of juicy at 3.9%. For me, the minimum standard of a dividend growth rate that is healthy and is beautiful is at least 3%. That way it keeps in line with the rate of inflation. With BP, they're doing just that, but it's a business model that I'm not exactly too excited about. Don't get me wrong, I don't think oil is going to go away anytime soon, at least for the next 10 to 20 years. But when we start thinking about the next 30 years, yeah, I do think their monopoly and the world's dependence on oil, it's going to slowly trickle down. I think we're slowly making that pivot into like lithium, EVs, solar panels, nuclear energy, and everything in that renewable green space. Currently, our presidential administration, they're very hostile to clean energy, so I think oil and gas should be thriving in the short term. But depending on who comes into office next, it could be a pretty rough time for them. So taking that into account, I'm just really not interested in going near them, okay? That's why, investing is really fun. It's all about personal preference. I'm pretty bullish on defense stocks like Huntington Ingalls, Lockheed Martin, Northrop Grumman. And for other people, they might be like, dude, absolutely bearish. And that's why I think it's kind of fun. And I still stand on that tiny hill. I'm not particularly a fan of Duolingo, but I will say this. From my calculation, if the stock price does hit around $100, I might snag some shares. Because at that point, then we're talking about value investing. But when Duolingo trades for $400, $500, $600 a share and their PE is absurd, a language learning app, that's where I hesitate. I know what I just said probably offended some people, but if you want the full analysis and deep dive, that's available up on the YouTube channel. And the next one is Merck. And I would argue this is probably one of the more high-quality pharmaceutical companies out there. And I say that because as a guy that used to be a strategy senior manager at one of the biggest pharmaceutical companies in the world, 99% of the businesses operating in the pharmaceutical space are very unprofitable and are contingent upon like venture capital and equity money just pumping into their veins in order to keep their doors and lights on, right? The pharmaceutical space is really complex. If you don't really understand the pipeline and the drug research and the clinical trials, I would argue, why go near it? Okay, as a guy that used to work in the pharmaceutical space, I don't even invest into it, right? So it shouldn't come as a surprise that for Merck, I'm just not interested, man. And I have a lot of colleagues that still work for Merck. It's a good company. It really is. If you're working for a 40-hour-a-week, beautiful work-life balance, non-hostile work environment, a pharmaceutical place is not bad. But as a potential investment, you want your money to compound, right? You want predictable, reliable cash flows. And I could go on and on. With the pharmaceuticals, I think you need a higher risk tolerance in order to invest into pharmaceuticals. And I wanted to circle back to what I was going to say earlier. So with dividend growth investing, like what's the value add for shareholders like you and I, right? Number one, when you think about the time value of money, which is the purchasing power of your dollar, when you think about it, your dollar today is going to be worth less 10 to 20 years ago. Likewise, your dollar today, your $1, is worth so much more than it was back in 1995 or even 1985. And that's why as the dividend payout increases, it keeps up with the cost of eggs, milk, the cost of a gallon of gas, with the rate of inflation. So to know that the purchasing power of that dividend payout is growing year over year, it's a good thing. And then number 2, with dividend growth investing, time becomes your teammate. And that's why if you truly categorize yourself as a dividend growth investor, you got to think long term. So all that to say, every year, your checks will get bigger, right? Like as you see on your screen right now, there's companies that are increasing their dividend payout by like 66%. Obviously, that's an anomaly. Mostly it's around a single digit number, the majority of it, but still, it increases. And as those dividend raises keep happening year after year, it'll eventually outpace your active income jobs pay increases. Because I feel like in the workplace, it's pretty common to see like a 3 or 4% end of the year raise. Like, hey, Roger, you've been busting your butt all year. You never took any PTO. We're going to reward you with a 3% raise. It's like, oh, golly, thanks, sir. But with like dividend growth investing, you don't need to kiss ass. You don't need to play politics. You don't need to go around the office space getting on your knees just to get a 3 or 4% raise. You get it by just investing into a high quality compounder. It's that freaking simple. Your income goes up, not because you work harder, but because the companies that you're invested into work harder. Does that make sense? That's why I feel like passive income and investing into dividend stocks just make so much sense. I feel like you either get it or you don't. And I say this, from time to time on the channel. I think most people start out as growth investors willing to go all or nothing. But once you get burned enough times in the stock market, I feel like you become more conservative and your risk profile, it goes down a notch. You're like, okay, maybe I am not so, I guess I don't have the balls to always go YOLO into calls and puts and to do options. And eventually everyone does become a dividend growth investor. I think that's true, right? Maybe that's just my own story and I'm projecting that onto people. Because I started out as a growth investor into the most speculative stocks. And once I got burned enough times, I realized, like, dude, this is not a sustainable way to invest. And that's not even investing. I think if you're day trading and you're doing options, you're jumping in and out of the market every other day, you're gambling. You're essentially gambling. But when you buy into a high quality business with the framework and mindset of holding on for the next 10 to 15 years, I would argue that you're investing. Because you have to give your investments time to marinate. You can't just keep taking it out of the oven every second. It doesn't have time to cook, right? If you want that perfect Thanksgiving turkey, you got to give it time to let the butter and the garlic and the herbs to seep into the milk and the juices to marinate. I don't know. I'll circle back. There's another point that I want to make, but let's continue on with the next one. And that's going to be Aflac. Right? They're primarily in the business of insurance and financials. Their dividend growth rate is 5%. I'm going to be honest with you. This one is a maybe. It really depends on the price. Their financials are a little shaky, and I would argue they're not an S, A, or even in the B tier when it comes to their peers. So when I think about the insurance space, there's so many high-quality players, right? I think about Berkshire Hathaway. I think about Progressive. I think about Travelers Insurance. Aflac, they're nowhere near them. But when we talk about the C tier, an average company, I think they're pretty average. I don't think they're the ugliest insurance. I think the ugly ones would be like Lemonade and then Hippo and then some of the other startup insurance stocks because they're not even profitable. But for Aflac, it really depends. I feel like given the choice, would I want to invest into them? Probably not. But if it's too good of a value to pass up, I might entertain them. The next one is Emerson Electric. To be honest with you, I'm not really interested. The next one is McCormick. They're in the business of spices, seasoning, and hot sauce like my girl Cholula. And they're also the parent company of Frank's Red Hot. If you go to any DFACT military base in the US, you will see a Frank's Red Hot. They must have an exclusive contract. I think it's a pretty good CPG company because when I analyzed and I did a breakdown of the entire CPG, food CPG space, I think they were like a B from my memory. Then again, I'm sleep deprived, so I don't remember off the top of my head, but what I do remember is that McCormick is very high quality, and I feel like with their production, dude, they're in the business of selling salt, pepper, right? Paprika, curry powder. It's way different, especially when you think about the overhead costs, such as like General Mills. That's another food CPG company that I am invested into, but for them to do business, it's a lot more expensive because when we talk about making kibbles for dogs or cereal for humans, it's a lot more expensive. For McCormick, I think it's pretty good. And that's why, given the right price, I think I would buy into them. And I'm also a fan of how their dividend growth rate is 6.6%. I think that's double the rate of what I deem acceptable. Now, obviously, higher the dividend growth rate, the better it is. 6.6%, I'm not going to lie to you, that's really good. And ConocoPhillips, exact same way that I feel when I talked about British Petroleum. Another oil and gas conglomerate. I'll be honest with you, they might be having a pretty pleasant short-term future the next 3 years, but when I buy into a company, not only am I assessing the short term, but I also want to know, are they going to be relevant and a compounder 10 to 20 to 30 years from now? Now, when we think about the oil and gas field, there's so much uncertainty up ahead in that roadmap that it makes me hesitate. Right now, obviously, if I just want to invest for the next 3, 4, 5 years, probably not the worst idea, but at this point in my life, I'm trying to be more selective and picky instead of just letting anybody into the portfolio. So for ConocoPhillips, it's a no way Jose. And the next one is Iron Mountain. This is a very interesting REIT because up until 2020, they were primarily in the business of safely destroying and disposing of sensitive paper documents for companies. Like every major S&P 500 company did business with IRM to get rid of their contracts and documents and everything. And they also pivoted into these vaults that would ensure, protect, and for you to pay rent money so you could store artwork, statues, furniture. Think about a $10 million painting from 500 years ago. You would pay Iron Mountain to make sure that painting stays safe, unless you wanted to put it up in your mansion. But going into 2021, they pivoted into doing data cloud services as well. And so their stock price just absolutely exploded. This is a company that I used to be invested in when I first got into the stock market back in 2018, 2019. I sold out of them because once they popped up 150, almost 200%, I was like, dude, I'm out. But had I just held on, my ROI would have been a lot higher. So Iron Mountain is one of those companies where I kind of regret selling out of, but given the right price, I would buy back into them. That's a perfect example of a company whose business model was outdated and was on the verge of going extinct, right? Shredding paper documents. How is that going to be relevant in 2025? And then they found a way to pivot their business into protecting the data, cloud, and anything related to the internet enterprise. So fantastic leadership team, and it tells me that it's high quality because they were proactive and they were able to pivot their business model to stay relevant going into the AI bubble. Next one is Roper Technologies. Completely transparent with you, I had never heard of this company prior to making this video, so I was like, what the heck is this? Because a 10% dividend growth rate, dude, that's pretty fantastic, right? Now I want to circle back to the value add for businesses that are growing their dividend, right? It's not just the shareholders that benefit. It usually signals strong financial performance because not always, don't be that jerk off, please, but for the most part, a company can't increase their dividend payout unless their profitability improves, like their net income goes up or the shares outstanding decreases. So when you think about it, Roper Technologies to increase their dividend by 10%, it tells me okay, I should pump the brakes and probably take a look at what this company is. And on surface value, I saw that their stock price right now, it's at a 1-year low. Now, before I get ahead of myself, What exactly is Roper Technologies? They're an asset-light conglomerate that buys out emerging niche software companies such as Vertafore, that's utilized in the property insurance space for them to calculate whether or not how much payments and premiums is fair for a certain customer. They also own the software Frontline Education, a one-stop shop for all the school admins' needs, including payroll, attendance, and system comms, like to send out a mass alert to all of the teachers about, hey, an emergency meeting in the gymnasium at 1 p.m. Their kid vomited all over the floor. We think it might be XYZ, whatever. They also own DAT Solutions, spelled DAT, which is the biggest exchange for truckers here in the US. For example, I started looking into what that is. Let's say there's 5,000 pounds of pumpkins that need to be hauled from Oklahoma to North Carolina. That Solutions, it'll match up the truckers that are available to make that happen in the next 1 hour, and the going rate, per mile, will pay you 85 cents or whatever. So kind of an interesting company, and I think we'll circle back and take a look at their financials to see if it is a company that's worth investigating or not. Because since they're near their 1-year low and they just made the executive decision to pump up that dividend growth rate by 10%, someone's wrong, right? Either the leadership team and the employees of Roper, they're wrong, or Wall Street has it wrong. So if Wall Street's wrong and their stock price is being unfairly punished, this is a company that I definitely want to look into, right? Not invested into them. And by the way, I'm not sure if I said it already. My brain is kind of slow today. I'm personally not invested into any of these stocks. So hopefully I don't come across as biased and disgusting. I think the only one where you might be offended is what I said about the oil and gas or the pharmaceutical space. That, I'm sorry. But as a guy that used to work in pharma, it's just once you have insider knowledge of how that sector operates, you either feel bullish or you feel bearish. And my takeaway from my time as a guy that used to partner with almost every single team, including the GTM, the go-to-market team, the marketing team, the sales team, the finance team, and everybody in between manufacturing, if I'm bearish, you know what I'm saying? I'm not trying to influence anyone, but it's just how I feel. And the next one is ADP, Automatic Data Processing. They're basically in the business of producing employment data analytics and payroll software for HR. And they're one of the companies that's responsible for the labor report every month. But obviously, as of the last month and a half, now there's no transparency. We don't know how many jobs were created, how many people lost jobs. That's one thing that kind of rubs me wrong. And I know there's a lot of people that are saying there's shadiness that's happening behind the scenes. But I feel like transparency is a good thing, right? For us to see the objective information and then for us to make a conclusion. But to take away all the information and all the data and we're operating in the dark, it's kind of dude, what is going on, right? And that's why when we think about the rate cuts, it's a more complex situation. Because if they understand the employment data and the job data, then they can make a more wise decision. But they're shooting in the dark at this point. So it's kind of a weird timeline that we live in. I'll say that, okay? So when I think about how they're being kind of shunned by the current administration and how I think AI is going to absolutely disrupt their space, for me, it's a no way, Jose. Granted, I think their dividend growth rate is phenomenal. So if you're invested into them, I don't fault you. It's just I haven't really done my homework on them. Obviously, I'm not an investor, right? So, but at a 10% dividend growth rate, it does make me curious, okay? The next one is Cinemark. And they increased their dividend by 12.5%. Cinemark's in the business of operating a whole bunch of different movie chains up and down the US. I'll be honest with you, as a guy that used to go to the movie theater every single Friday, sometimes Saturday as well, growing up in the 90s and 2000s, it makes me sad to know that the movie theater space is dying. But it kind of makes sense because now we can just stream whatever we want to watch, in the comforts of our own home, butt ass naked on the couch, and you don't have to pay a $20 ticket. So I get why that industry is dying, but it's kind of sad because as our kids grow up, I don't even know if movie theaters will still be around because they're operating at a loss. Well, I guess for AMC, they're operating at a loss. I'm not really sure about Cinemark, but I will say this. You might be impressed by the 12.5% dividend growth rate, but they did cut their dividend back during the pandemic. And as I say always, right? Once a cutter, they're always going to be a cutter. Whenever there's hard times, once they show in their timeline and DNA that when the going gets rough, they cut their dividend, it's only a matter of time before they cut it again. There's so many different examples of companies that fall into that. When I think about Intel, when I think about JCPenney's and some REITs, once you cut that dividend, as an investor, that's got to make you reevaluate, like, what the heck? Because you don't cut the dividend unless you absolutely have to. Because I think that shatters the investor confidence in the business. That you can't forecast your financials. You don't know if your guidance is going to pull through or not. That's why you just cut it. Now, another company that is going to cut their dividend very soon, they came out and straight up was like, hey, we might have to cut it up to 50%, maybe even more, is Alexandria Real Estate. That's a company that I'm looking into. They're primarily in the business of renting out office space for biotech and pharmaceutical companies. And obviously right now, everybody that's operating in that space, they're suffering because they're losing funding from the government. And because they're losing that funding, they also don't need as many researchers and scientists working on various projects, right? They're saying, dude, we might cut our dividend, ticker symbol ARE, and I'm looking into it. After they cut their dividend, I might jump in. Might. I'm not saying I'm going to, because I don't like dividend cutters, but they're at a valuation right now. I haven't looked into them all week, but when I looked into them last week, they were at like a 10 or maybe a 20-year low, which is pretty absurd. Because usually when you think about the life sciences, pretty high quality industry, right? I think this is like the first time in decades where funding for cancer research and medical research has just been slashed across the board. And that's why I'm thinking like, I think they're going to be in pain for 3 years, so it might be a good time to pick up shares. I guess going back on what I just said, once a cutter, always a cutter. But when I think about them, I feel like it's a very unusual timeline, as I alluded to earlier. There's a lot of stuff that's happening in 2025 where it's kind of like, you almost got to shake your head and go like, what the heck? It's a weird time. I don't know. Maybe I should stick to what I said and just avoid them. But it is something that I am eyeballing. But anyways, with Cinemark, obviously a dividend cutter, not too interested. And I'm not bullish about the physical movie theater business operation going forward. The next one is Capital One. I really, really like this company. Now I'm from Virginia. They're headquartered in, I think, Richmond, Virginia, or Nova. I can't really remember, but a lot of my friends from college, they work at Capital One. I know it's a good company. And they also acquired Discover. And Discover is a company that I went balls deep into during the pandemic, and I made a pretty penny. And I just held on to my shares. And then once Capital One purchased them, I was like, okay, whatever. But really good company. I like it. I would buy into them, but right now I'm kind of more into American Express. If I had to buy one of those credit or payment processing companies. And then second place, I'm kind of eyeballing Visa again. Visa is a company that made me a lot of money in the past. Right now, I still think their valuation is a little too high, but right next to Visa, I would argue is Capital One. And then also MasterCard is staring at us in the corner like a creep. Pretty good. But American Express, if I had to pick one right now. But a 33% dividend increase, that is pretty phenomenal, right? So given the right price, because I don't just like to buy at any willy-nilly price, but at the right price, I would buy a lot of Capital One. The next one, it's a name that should be familiar with everybody, okay? It's Taiwan Semiconductor Manufacturing. They're basically in the business of producing almost all of the major complex GPU chips for NVIDIA, for Marvell, for AMD. Without them, the AI movement would just be shattered. 50% dividend growth rate is just absolutely absurd. Super high quality. Love this company. I think the only thing that holds them back is the whole idea of their bigger neighbor threatening to take them over seems like almost every other day, right? So that is something to be wary and cautious about. But I don't know. I live in Japan, and I saw on the news that Japan is they're going pretty gung-ho against that neighbor, the hostile neighbor or whatever. So I feel like if they do make any move, if Japan gets into a fight, I feel like the US will get dragged into it as well. It'll be a hot mess. But anyways, TSM, pretty high quality. Given the right circumstances, I would buy. I'm not invested into them, but I would like to buy them. And then the last one is Vertiv. They were featured in my HVAC industry video where we looked at every single business that operates in the HVAC space. And I said they're in the S tier. They basically do HVAC on steroids for data centers to keep the equipment nice and cool. So they don't really make your traditional, air conditioners or heaters. They're basically making data centers the perfect temperature. That way they can be optimized in their operations. 66% dividend increase. I mean, come on. It doesn't get any better than that. Now let's go ahead and take a look at some of these companies, and we'll be talking about their financials. First up, let's go ahead and talk about Tyson Foods, ticker symbol TSN, year to date. I think it's going to be red. Yeah, negative 7%. Past 1 year, 17.8% into the red. Their 1 year low is $50.56. Effectively, they're pretty much near their 1 year low. If we do 5 years, they're at their 5 year low. Okay, if we bounce on over to their financials, it's not bad. It's not bad. But this is a company that's usually hit with scandals almost every year or every other year. So when you're invested into them, you have to bake in that you're going to have inevitable setbacks with their food handling, with accounting probing, and other setbacks that are usually not plagued in a company. Let me see if they're... Yeah, in 2023, they were unprofitable, and they're on a bad trends right now. That's not what you want to see in the net income, right? Jump on over to their free cash flow. I imagine it's not going to be good because they're manufacturing and selling meat. And that's a lot of overhead costs. I think, from my understanding of Tyson's, it's been a while since I looked into this company. I think they pay the farmers to do all of the heavy lifting, and then the farmers sell the poultry meat to them at wholesale prices. So Tyson's, they're not in the business of raising those chickens. They're just in the business of processing those chickens into something that'll be on your plate for dinner. So I think the free cash flow wouldn't be fair to look at, but I just want to take a look at it. Oh dear, 2023 was a terrible year for them, wasn't it? And even right now, it's a terrible year. I mean, they're at their 5 year low. Dividend yield, 3.8% is pretty juicy, but as I alluded to, 150% dividend payout ratio, that is not sustainable. What I mean by that is the dividends per share is $2.04, right? For every share of Tyson's that you own. And if you take a look at their bottom line per share, it's $1.33. Usually, you afford and you account for the dividend from the profits per share. So $2.04, how the heck are they affording it? My educated guess would be if you jump on over to their balance sheet, they're dipping into their cash that are on the books. That's primarily why it dropped by 29% year over year, but they're also probably utilizing some of their free cash flow because, as I said earlier, the last thing you want to do as a business, unless that's your only option, is to cut the dividend. Because once you cut that dividend, dude, it's usually a free fall for the company. You get rid of that dividend, and so many ETFs that require a dividend for you to be included, you're going to be cut from millions, if not billions of dollars of market capitalization. And then also there's individual and institutional investors that will sell out of you as well. Because if you're a passive income investor, it makes no sense that you're invested into a chicken meat seller if they don't pay a dividend. Another one I said, no way, Jose, was Cinemark. Let's take a look at their numbers real quick. Year to date, 11 and a half months, negative 2.8%. 1 year, 5.9% to the red. 5 years, 100%. You would have 2x your money if you had invested into Cinemark at the end of 2020. That's a little surprising to me because when we take a look at their cousin from West Virginia, yeah, they're in that penny stock status right now. Negative 92% in the past 5 years. I remember during that meme stock frenzy, I think GameStop and AMC and Bed Bath & Beyond and some of those other companies, dude, they just skyrocketed. And AMC at one point was $522 a share before the stock splits. I'm assuming there were some stock splits in here. To be $2 a share right now, if you're invested into AMC, bro, I don't understand you. Like, I don't see the logic here. It's a dying business model. Likewise with Cinemark, I'm kind of like, why, man? Why? Obviously, during the pandemic, I can see why their revenue fell off the cliff. $3.2 billion down to $686 million because we physically could not go to the movie theater, right? 2021, they made a pretty decent bounce back. And I'm not going to lie to you, it's pretty stabilized in their financials. It's not bad taking into consideration their top line. But what about their earnings per share? Yeah, this is a pretty hideous picture, dude. It's volatile, inconsistent. It's not growing. 2015 profits per share, we're talking about $1.87. Now it's $1.11. I mean, think about it, right? If you're buying a business to become an owner of it, do you want to know that their profitability is increasing with time? Or do you want to know that it's decreasing? For me, like with Cinemark, dude, it's a red flag. I mean, if you don't look at the numbers, you might just look at their dividend growth rate and be like, dude, sign me up, right? But take a look at this, right? Their dividend went from 36 cents every quarter, and then when the pandemic happened, they cut it. And then the next time that they reinstated that dividend was in 2025. So kudos to Cinemark for bringing back the dividend, but bruh, you got rid of that dividend for 5 years. So don't be fooled. Likewise, when you see a company that has a very juicy dividend yield, that's like 8% or 9%, but their financials are just booty hole, another reason to just throw up that red flag and be like, okay, why is the yield so high? Now with Cinemark, obviously the yield is low, but I guess in this lesson, it would be the dividend growth rate, right? It's so freaking high, one could confuse it as being high quality. It is not. They are not high quality. Now, on the other hand, let's talk about some of the more high quality companies out of that entire list, the ones that I am willing to buy, I'm not invested into. The first one would be Capital One Finance, right? They're in the business of credit cards, debit cards, online banking. I mean, this is phenomenal, but ooh, what is going on with the payout ratio? Why is 109%? I'm assuming it's probably with the acquisition of Discover, and their books are probably all wonky. So in the case of Capital One Finance, $2.40 of dividends, a quick napkin math is to go over to their free cash flow per share. Their free cash flow per share is $43.52. So when you think about it, their dividend payout ratio is like 1, 2, 3, 4%. It is absolutely affordable. I haven't done a deep dive to take a look at how their net income got so butchered. Right, it's going from like $11.95 to $2.38. I'm going to go ahead and assume that it's because they acquired Discover Finance and it made all of their books wonky because they took on Discover's loans and all of their books are now Capital One's books. But as a litmus test, just taking a look at the free cash flow per share, I think their dividend is safe. So that payout ratio is absolutely deceptive. It's sustainable, okay? A 1.2% dividend yield, I know it's not juicy, but this right here, my friends and family, is juicy, and I like that. Yeah, this is good. This is a company that I would buy into. I mean, it's exactly what I want to see. Take a look at their top line year over year. It's going from $18 billion in 2015 to $28 billion. Now that they have Discover under their arm, their revenue should exponentially get bigger, right? That's called inorganic growth. When you acquire and buy out the competition and their revenue becomes your revenue, you just inorganically grew your top line. Because organic growth is you making more money through your own product and service. But if you buy the competition, then it's like, oh, they're adding on to your revenue, but it wasn't organic growth. Hopefully that makes sense when people talk about organic versus inorganic growth. The next one is TSM. I like this company. When I went balls deep into AMD and NVIDIA, this is a company that I was seriously contemplating jumping into as well, but I was just like, you know what, I might as well just go with the one that without them, the AI movement would fold. But I guess one could say the same thing about TSM. Looking back, I think it was the geopolitical barriers where I was like, but I guess one could say the same about NVIDIA and AMD. Because I think the current administration, they're restricting them. It seems like every other quarter, there's like a sanction or a ban saying, oh, you can't export this type of chip to China. And it's like, oh, it hurts the bottom line for an NVIDIA and AMD. So, I don't know. I guess AMD, NVIDIA, or TSM, there was no wrong decision. But yeah, this is a freaking phenomenal stock. You would have 3x your money in 5 years. Take a look at their financials. Just absolutely disgusting in a beautiful way. Oh my goodness gracious. I mean, is this in, it's in Taiwan dollars. I was like, how the heck are they pumping $3 trillion of revenue? That's in Taiwanese dollars. So yeah, but 36% growth year over year. Take a look at their bottom line per share. Yeah, dude, this is phenomenal. I would love to have TSM in my portfolio. Unfortunately, at their current stock price, probably not going to happen because I'm a value investor as well. Obviously, I prioritize dividend growth, but I'm also a value investor. I never, ever, ever want to make the mistake of overpaying for a company. I think I used to do that early on, like 7 years ago, and I got burned badly. Because when you buy at the top thinking, oh my gosh, they're going to keep pumping. Like if I bought into TSM at $300 a share first week of October, now they're $282. I would be in the red, right? And it's a psychological thing. Like if I bought TSM because I'm going to hold on to it for the next 20 years, not the worst thing in the world, right? Because if I zoom out and take a look at it, say I did the exact same kind of scenario like in 2022, January, I bought it at 140 and they dropped all the way down to like $62, I would be devastated, right? But give it enough time with a high quality company, they usually go up, right? Their stock price usually matches their financial performance. And now that it's 282, it wouldn't really matter. So I guess that example is not really good. Because at $300, yes, it's 282, I would be in the red. It's not a good feeling, but it's just one of those things where I would rather buy a company on the dip. So to buy them during that April debacle at like $150 a share, sign me up. That's when I like to buy stocks. I don't like to buy it when they're at their 1 year high. Because if I buy it at April, as a long-term investor, not only do I have a really good cost basis, but I'm also going to be seeing green consistently, right? You buy it at the top, you're going to see a lot of red days as they trade sideways on their way up. I'm not going to say they're always going to go up, but for TSM, it seems like for the foreseeable future, they're going to be printing cash, right? So high-quality company, but at their current valuation, actually, I don't know if I can even argue that. Their PE is a 22, their forward trading multiple is a 19. So even though their stock price might be high, valuation seems kind of low. Okay, I might have to look into this company again. I think another one we talked about was Roper, right? Yeah, take a look at this, right? They're at their 1 year low. They're almost at their 5 year low. Let's take a look at their financials really quickly. $3.5 billion in 2015 to $7.7 billion for the past 12 months. Profitability went up. So I want to know what exactly happened. Oh my gosh, that was a one-off year, 2022, $42 of profits per share. Like what happened in their most recent earnings for them to go off a cliff like that? Was it bad guidance? Was it a scandal? Was the CEO caught cheating with the HR director? Like what happened, right? I want to find that out. Free cash flow. I mean, this is a asset-light company, so they're free cash flow. There's no excuses. It needs to be immaculate, and it is. So far, this is good. This is a company that I need to really look into this weekend because I don't think I've ever heard of anyone talk about Roper Technologies, ever. And what makes it even crazier is that I'm pretty sure they're in the NASDAQ 100. So it's a pretty prominent business operation. A 10% dividend growth rate. Oh, my dogs are going wild over there. 23% payout ratio. Not bad at all. Not bad at all. And the last one I want to talk about before I sign out of here is going to be Vertiv. They were featured in the... Oh my gosh, my dogs are going wild. Usually that's when my wife comes home because they love my wife. Dividend yield is 0.09%. Kind of low. Dividend growth rate is 55%. I mean, that's what I really like, right? The payout ratio is just funny. The growth, though, 2 years, what's going on here? So it looks like they just started paying a dividend during the pandemic, and it's growing up consistently, right? Every year. But they don't seem like they're a consistent payer. It looks like they used to be an annual payer once a year, and then they went to every quarter. That's a really weird decision. Take a look at their top line. Yeah, this is freaking phenomenal. Their earnings per share 77% year over year. Because I was going to say, usually when you see a dividend growth rate of 55%, their EPS needs to match that energy. It needs to be at least like 70%. And in the case of Vertiv, that's exactly what's happening. Because usually the revenue would also be around 70% year over year, and then it trickles on down to the EPS. But it looks like they're becoming more efficient with the way that they're operating because their margins are increasing, reflected by the profitability, right? So this is a company that's been on my watch list for a while. I don't know if I'll ever get the chance to jump in. Back in April, I should have done it. I should have pulled the trigger, but I bought into Google and Microsoft instead. No regrets. I also think that was the right decision. Vertiv, wish I could have bought into them. But anyways, what do you think? Are you invested into any of the companies that we talked about here today? Which ones are you a fan of? Which ones do you hate? What do you think about my ratings, right? Do you think they're fair? Do you think they're ridiculous? Let me know. And as a reminder, I'm not invested into any of them. But with that said, if you made it to the end of the video, I love you guys. Thank you for supporting the channel. It really means a lot to me. Good luck in the stock market. Stay safe, and I'll talk to you next time. I'm so freaking tired and sleepy. So, probably gonna take a nap. Peace.